Hello, everybody, and welcome back. Today, my guest is Andy Rothman. Andy is an investment strategist at Matthews Asia, and today we want to discuss recent development in China and China equity market. Welcome, Andy.
Great to be here with you.
Andy, financial markets were not amused by Xi Jinping's new agenda for his third term. So, what importance do free markets and trade have for Xi and the new Politburo?
Great question to start with. I would argue that Xi Jinping doesn't spend a lot of time thinking about the stock market in China, which is probably good. But I think what's more important is that often investors aren't really understanding what's going on in Xi Jinping's head. So while the initial reaction by investors to what happened at the Party of Congress back in October was somewhat negative, pretty quickly, I think more investors understood that Xi Jinping was course correcting back to a more pragmatic policy approach, more pragmatic in dealing with COVID, with dealing with regulation of the tech sector, with dealing with regulation of the property sector. And as we've seen, the market's been a lot happier in the last several weeks.
Hi there, just a 2-second break. Before we continue with the video, just make sure to subscribe to our channel now to not miss out any updates. Thank you very much and enjoy the video now.
So the worst case for the financial markets would be a military confrontation around Taiwan. So Xi has fueled this fear with his speech, mentioning security issues several times. So how realistic is such a scenario for the coming years?
There's a lot of things to worry about with respect to China, but military conflict across the Taiwan Strait is not on my list of things to worry about. I think that this is another example of how many people misunderstood what Xi Jinping was saying. If you read the 64-page speech he gave at the Party Congress, the emphasis actually was on economic development. And the language that he used with respect to Taiwan wasn't at all different than what he and previous leaders have said. And what they're really focused on is aspirationally the eventual return of Taiwan to mainland control. But there's no deadline, there's no timetable. And he repeated the same thing that other leaders have said, which is their priority and preference is for this to be peaceful. So I think that the media is really overhyping this story. And I think that if you look back over the last few decades, it's been one of stability across the Taiwan Strait, an environment that's allowed Taiwan to move from martial law just a few decades ago to a thriving democracy with the rule of law and a place that's become really wealthy. And I think that's likely to continue. Now, of course, it's going to remain tense, but I do not think that there is a significant risk of the Chinese government using force against Taiwan.
So the lifting of the draconian COVID regime came quite unexpectedly in the end in China. So how will the seemingly disorderly withdrawal affect the Chinese economy in the short and medium term?
Well, actually, I was not surprised that they made this change. I've been arguing since April, back when we saw the really harsh lockdowns in Shanghai and some other cities, that the zero COVID policy, which had worked really well in 2021, was no longer suitable, and that before too long, Xi Jinping and his government would recognize that and make changes. I think they were forced to make changes because the current variants of COVID are very different, far more transmissible, but less deadly than the previous ones. And so zero COVID just doesn't work to stop that, to deal with that public health problem. And then they had to resort to lockdowns, which were having a horrible effect on the Chinese economy. So really, since last April, I'd been forecasting that there would be a change. Now, the change has come more quickly than I expected, which is good. And of course, it hasn't been handled as well as it should have been. Primarily, the government wasted an opportunity in the second half of last year to get more elderly people vaccinated. So it's been more chaotic, but I think we've already seen the first wave of COVID in major cities, and China's come out of it reasonably well. And so I think actually the return to normal activity and normal economic activity is really coming soon.
China's real estate sector is in a structural mess. So how long will this affect the Chinese economy? And is the government doing enough to counteract this crisis?
Well, I would use different words. I don't see a crisis in the real estate sector, and I don't think it's a structural problem. Let's go back to basics in the property market. It's really important to understand that China has avoided most of the problems that led to the housing crisis in the United States about a decade ago. For me, if you look back to that, there's only one statistic you need to know to understand why we had a housing crisis here in the United States. And that was in 2006, before the crisis. The median cash down payment for a new home in the United States, the median was 2% of the purchase price. And then add to that, we had all this creative financing for mortgages, right? Balloon option arms and no money down and ninja loans and all that stuff. In China, by regulation, the minimum cash down payment for a new home that someone's going to live in as their primary residence is 20% of the purchase price. When we look at bank balance sheets, we see that the average new home buyer is putting 30% cash down, and it's all plain vanilla mortgages. So we don't have the kind of financial risk that we saw in our housing system before. We also know from surveys that about 90% of the people buying a new home in China are buying it to live in as their primary residence. So there's not a lot of speculation. So for those reasons, I think that fundamentally the market is sound. Now, the market has passed its peak. The growth rate of prices, the growth rate of sales volumes has been slowing down for several years right now. That's not surprising. It's a more mature market. The real problem in the Chinese property market was really stupid government policy over the last few years. And the government has finally acknowledged that they made mistakes and said that they are withdrawing those bad policies. And then the other issue was the COVID lockdowns. Who wanted to go out and buy a new house if they were locked down or afraid of another lockdown and might lose their job or their business would fail? So what I think we're going to see is gradually over the next several months, market activity pick back up. And I think the second half of this year, we're likely to see a pretty good recovery in the property market. Year over year growth rates are still going to be weak, but I think we're going to see things moving in the right direction. And remember, the government's now encouraging this. Last year, they were discouraging new home purchases, but now they've cut mortgage interest rates by over 100 basis points.
The semiconductor sector in China is affected by the strong US sanctions. So how effective are these measures? And can the sector thrive without US technologies in China?
Yeah, these new restrictions by the Biden administration, I think, are primarily going to have a political impact in the near term rather than an economic impact. First of all, we have to remember that there isn't much of a semiconductor industry in China right now. China imports over 80% of the semiconductors it consumes, most of that coming from Taiwan. All the most sophisticated chips used in China come from Taiwan. So when we look at the semiconductor industry in China, it's in its infancy. And the restrictions that the Biden administration has put in place are really on high-end chips. So I think in the near term, the impact is not going to be significant. For really high-end uses, let's say for cloud by some of the big platform companies, it might mean their operations are a little bit slower, use a little bit more power, but I don't think it's going to have a big impact. In the longer term, I think what it's going to do is accelerate development of the Chinese chip sector. In the meantime, the negative consequences are it raises tensions in the bilateral relationship between the United States and China. And I think it also raises tensions between the United States and governments in places like the Netherlands and Japan and South Korea, because Washington is now pushing them to take a tough line on China on semiconductors.
Big tech and internet companies in China in particular have been hit hard by some sanctions. So is a sustainable easing in sight? And what are the prospects for Alibaba, Tencent, and other Chinese big tech companies?
Yeah, I mentioned a moment ago that the government made some really, really bad policy decisions over the last few years on the property sector, which they're now in the process of correcting. And the same thing applies to the tech sector. I mean, I understand, I think, what Xi Jinping's worried about. He talks a lot about common prosperity. And I think this means that he's worried about the same things that we're worried about in our countries too. rising inequality of wealth and income, unequal access to housing and education and healthcare, and also the fact that some of the large online companies are getting too powerful and maybe using some monopolistic practices. But when he went to try and come up with solutions to these problems, he went too far and did some really dumb things, including especially on the tech sector. But for a number of quarters now, the government's been acknowledging that they went too far and made mistakes, like with property. And they've been saying that they're going to apply a much lighter regulatory touch to the tech sector this year. And for the time being, I'm going to give them the benefit of the doubt and say I believe this, because these companies are really important. They drive job creation. They're really important part of the consumer part of the economy. And I know some people are saying, well, Xi Jinping only likes the hardware part of the tech sector, not the platform and software side. Well, who consumes hardware in China? It's these platform companies. So I'm actually quite optimistic that with the end of zero COVID, we're going to see a lighter touch and better performance by these companies. And I think that will reassure investors in the coming quarters.
Chinese stocks have had 2 bad years. So what are now currently the key risks and opportunities for Chinese stocks? And what can we expect from Chinese equities in 2023?
Yeah, it's been a terrible couple of years. Performance has been bad. I'm optimistic. Valuations are quite reasonable right now for the kinds of companies that we look at, which is primarily at Matthews Asia, looking at Chinese companies selling goods and services to Chinese consumers. And the reason we focus on those kinds of companies is the consumer and services part of the economy is the biggest part, the part that's generating all the growth, all the job creation, all the wealth creation in China. It's where most of the innovative, privately run entrepreneurial companies are. And valuations there are quite reasonable. We've seen the most important thing is we've seen a shift in Xi Jinping's government, which I think is back on course to pragmatism. Pragmatic about COVID, pragmatic about property, pragmatic about tech regulation. And I think just getting out of the way of the entrepreneurial, privately run companies that generate all the new jobs in China, all the wealth and all the innovation. So I'm quite optimistic that this is going to be a much better year for the markets in China.
So this was Andy Rothman from Matthews Asia. Thank you very much, Andy, for being with us today and sharing your insights into current developments in China and China stock market.
Good to be with you. Thanks.